Hi, everybody. I'm Patricia Greenberg, the Fitness Gourmet. Welcome to Eat Well, Live Well, Age Well, a series that addresses all topics of everything we want to know as we age. We're a pro-aging program to helping you navigate and feel good about your life going forward, regardless of your age, to be happy, healthy, and always moving forward in everything you do. So we talk a lot about what do we do with end-of-life care. And it's a scary topic and a lot of people don't want to talk about it. And unfortunately, most people don't want to address it. And it's one of those things that we need to start looking at a much younger age than we realized. When you are feeling vital in your 40s and your 50s and your 60s, it's wonderful, but it's very important to plan for later in life, which would be your 70s, your 80s, and hopefully your 90s. I'd like to live to be 120. Let's hope that that happens. But what I would like to do is prepare for that. And one of the most important things about preparing for your old age is so that you don't burden your family and you don't have catastrophic consequences for your family while you're living or even after you're gone. So my guest today is Robert Smith. Robert Smith is going to tell us all about how to set up your insurance and your needs for as you get older. Robert has 3 decades. He's got a lot of experience as an insurance and financial services professional with the firm Fraser Financial Group. And he's got more certifications than we have the time to discuss, which is fantastic. But most importantly, and most appropriate for today, he has a certification for long-term care. He helps his clients protect against the financial risks associated with death, disability, taxes, retirement, and of course, the cost of long-term care. So Robert, we're going to delve into this and talk about why this is so important. So first of all, what is long-term health care insurance?
So I think that before we get to that, let's talk about what long-term care is.
Okay.
And this is when you need someone who is going to take care of you due to your age or due to perhaps a medical condition. Typically, it's mobility related or cognitive related, and long-term care insurance is designed to help pay for the costs of that person who you need to take care of you.
And let's talk about, I think this is kind of a self-explanatory question, but why is it so important?
Well, the statistics on long-term care needs are absolutely staggering. If you go to the U.S. Department of Health and Human Services website, it says that 70% of people who are turning age 65 today will need long-term care at some point during their lives. In addition, because if you are married, your chances of living longer are greater than your chances if you're not married. As a result of that, there's actually a 90% chance, if you have a married couple and both of them are 65, there's a 90% chance that at least one of them will need long-term care at some point during their lives.
Wow. Wow.
The average length of time that someone needs care for is 3 years. And if you project out 30 years based upon how costs of long-term care are growing over time, if you project out 30 years, someone who needs 3 years of care 30 years from now is going to spend upwards of $700,000 on that over their lifetime.
Wow.
And part of it has to do with the types of care that are more and more being needed. Because most of these cares are now chronic and they're long-term. And it has to do with advances in medical technology keeping us alive longer. That's the good side. So if you look at, for example, at deaths from heart disease from 2000 to 2017, when this most recent study completed, deaths due to heart disease over that period of time actually dropped about 9%. But deaths due to Alzheimer's increased by almost 150%.
Oh my goodness.
The average Alzheimer's person from the time they're diagnosed lives 8 to 10 years. So that's a lot of care that's needed. Today, if you look at people over 85, which is one of the fastest growing populations in the country, actually 38% of Americans over 85 have Alzheimer's and 64% of those are women.
Yeah, those statistics are staggering. And I think it's something that we're all afraid of losing our memory and unfortunately going down that path. But again, I don't have to tell you, the more preparation you take now, in the event, God forbid, you're faced with it, the better it will be. We're probably going to talk about this later, but let me just throw this in. For long-term care, Does it work for only someone who chooses to stay in place, or it's also applicable if someone were to go to a facility of some sort?
That's a great question, and it's really essential that you buy a policy that covers you in both places. Almost every policy today does, at least every individually sold policy. A lot of policies that are sold through the workplace don't, or they don't offer the same percentage care. Some people only want to be in a facility because it's too hard to be taken care of at home. With COVID-19 and what we've seen in some failures in a lot of facilities, a lot of people maybe will want to be taken care of at home in the future. So it's really essential that whatever policy you get have the same amount of coverage, the same definitions of coverage, both for home care and for facility care.
So what are the alternatives to long-term care insurance? What would be some other avenues you can take if you didn't have it or you choose not to buy it?
Yeah, I would say there are probably three primary alternative avenues, and none of them are really very appealing. Mm-hmm. The first is just to pay for it out of pocket, right? You take money from your assets, from your retirement savings, from your bank account, and you pay that. That's a pretty expensive way of paying for things. Insurance is designed for high likelihood, high cost situations. So if you go to Best Buy and you buy, like I did, the camera for my computer and it costs $40, I don't need to buy insurance for that, because if it breaks, I can take care of that. But when something's really expensive, that's when you need to do it, and especially when it's a high likelihood of it happening. And we just saw what the percentages were. A few years ago, there was a study done that took the average premium for a long-term care policy from 2014 and said, well, what if you, instead of buying that policy, you took those same premium dollars and invested it, and you invested it for 22 years. And the study found that at the end of 22 years, if you needed care, the money that you invested on your own would pay for about 3 months, would pay for about 6 months of care. If, on the other hand, you'd use that money to buy a long-term care policy, it would pay for about 3 years worth of care. So if we think about that $700,000 that we talked about earlier, of the average cost 30 years from now, you're basically taking 5/6 of that amount is now going to have to come out of your pocket as opposed to letting the insurance company pay for it. The same study also found that those who have long-term care insurance tend to reduce their monthly outlays for long-term care, or at least their personal outlay for it, by about $3,000 to $5,000 a month. Those who have long-term care insurance typically receive about 35% more care in terms of number of hours each week than those without it. And the care is usually more likely to address their needs than someone who pays for it out of pocket. So that's one option. Second option is you can use an informal unpaid caregiver, which is typically a family member. That has an enormous impact on the individual and on the family. In a third of all cases, caregivers provide care at least 30 hours a week. So of those caregivers who are doing that, half of them estimate that their income from their own jobs drops by about a third. And 75% of these caregivers are women. So this affects women's finances most profoundly. There's also an emotional and physical impact from doing that. 25% of caregivers to dementia patients are actually sandwich generation caregivers. Right. So they're taking care of older adults and they're also taking care of their children. Another third of caregivers are 65 or older themselves. So it should be no surprise that about a third of those caring for people over 65 describe their own health as poor or even frail. And the example is, and we had this in my family, we had an aunt and uncle like this. If you have an 80-year-old, somewhat heavy male who's being taken care of by a 78-year-old, somewhat smaller and frail or even healthy wife,
right?
If he falls down, my uncle had Parkinson's, how do you pick him up off the floor? How can she do that? And in their case, she was the primary caregiver. She was the healthy one. And of course, she was the one who died first, as a result of that care. The last semi-option or sort of option is Medicare or Medi-Cal, or in California, Medicaid in other parts of the country. But the assumptions about what Medicare and Medicaid or Medi-Cal will provide, most people don't really understand them. For Medicare to qualify, you have to receive care in a skilled nursing facility after what's called a qualifying hospital stay. So if you're not in a skilled nursing facility, you're not going to get it. If you weren't in the hospital first, you're not going to get it. And even if you do get it, the most Medicare is going to pay for is 100 days. So that's a lot shorter than the 3 years of average care that we talked about. In my mother's case, She was 86. She had a stroke. She was in a skilled nursing facility for 2 weeks. The doctor said, she's not going to improve. We can't keep her here any longer. And Medicare immediately ended on that.
Okay. Yeah.
Medicaid. So that's just, how those work.
Right.
Medicaid or Medi-Cal, you basically have to have no assets left. So it varies by state, but typically the maximum, what's called countable assets that an individual applying for Medi-Cal or Medicaid can own is about $2,000. If you're a married couple, the amount of assets you can have to your name and you're both applying is about $3,000. And it even affects a spouse who doesn't need care. If you're the healthy spouse and your spouse is applying for Medicaid or Medi-Cal, typically you have to have under $125,000 worth of assets. And typically you can't earn more than $3,000 a month. So unless you're really planning on getting rid of all of your assets, or unless you really don't have any assets, those Medicaid or Medi-Cal are really not the place for you.
And the majority of Americans are between a rock and a hard place because they have too much to qualify and not enough to take care of a family member. So
Exactly.
That's a very frightening prospect. What triggers the payment of long-term insurance benefits? We talked a little bit about that before we got on the air of, how does this actually work? What are the nuts and bolts of this?
Right.
Mm-hmm.
And you should know that every policy sold by every company has the same basic framework to it by law. So to qualify for long-term care benefits from the insurance company, you have to need help with 2 of 6 what are called ADLs, activities of daily living. Those 6 activities are dressing, bathing, eating, transferring, continence, and toileting, which means getting to and from the bathroom. Transferring means getting from a chair to a bed or a chair to a couch or something like that. So you're going to need help with 2 of those 6, or you have a severe cognitive impairment such as Alzheimer's or dementia, where you can do pretty much anything, but you don't know what you're doing, and therefore you're a danger to yourself or to others. The care can be either hands-on care, or it can be standby care. So hands-on care means someone actually has to hold you as you walk. Standby care, someone needs to be near you so you don't fall when you do that. The doctor has to attest to the insurance company that their prediction is that you're going to need this care for at least 90 days. So we're typically looking at chronic conditions, though not always. Sometimes we'll have acute conditions that are going to end in the future, but typically chronic conditions. Cognitive conditions certainly are something that's not going to ever stop in the future. And the only thing to keep in mind is that the insurance company does have the right to go to another doctor, typically one of their doctors, and ask the doctor for a second opinion upon your care. In most cases, it's pretty obvious what's going on.
Yeah, I think that is an unfortunate consequence of all the fraud that goes on.
Right.
And,
But again, if you have dementia, you have Parkinson's, you have you're old and frail.
Yes.
It's pretty easy for the insurance company to determine that.
Yeah. Now, how are the benefits paid?
So you can purchase either a daily benefit or daily benefit maximum or a monthly benefit maximum. These are reimbursement policies. So whatever dollar amount you choose, they will pay you up to that dollar amount of care. So if you have $150 a day of care, if your care that day costs $100, they'll pay you $100. If it costs $200, they'll pay you $150. You can buy basically whatever amount you want in $10 increments, $100, $150, $170, $190, $230, whatever the case is. And obviously the more benefit amount that you get, the more expensive the policy is. And so you have to decide, do you want to try to insure every last dollar? Do you want to insure just some of the dollars? And so forth. Every policy has a benefit period. That's how long they will pay you the benefits for. Mm-hmm. And it's actually the dollar equivalent of that benefit, of that number of years. Typically, policies offer you the choice of 2, 3, 4, 5, or 6 years. And again, the longer the benefit period, the more expensive the policy premium is. In California, you are lucky that the care can be provided by anyone. It doesn't have.
That was my next question, right?
It doesn't have to be a licensed nurse, an RN, an agency. As long as you're paying above the table and you have a receipt that you get back from the caregiver. In California, anyone can provide that care. And then we already talked about, as you asked me earlier, care should be able to be received anywhere you want it to be received, whether it's at home or whether it's in a facility.
So can you technically, a spouse, collect payment for caring for
Good question. The answer is no.
Okay.
The care cannot be provided by an immediate family member.
Okay. Mm-hmm. Yeah,
And that's very
that's
important.
where the
And
tricky part
frankly,
comes in.
the whole
Mhm.
reason you're buying this policy is to avoid that situation of having
Right,
a family
right.
member take care of
And
you.
I think that's one of those, choose from menu A and menu B,
Right.
where part of the day is taken care of by a spouse or a family member, and then part of the day is a caretaker comes in.
Right.
Because what's so unfortunate, Robert, we see this all the time, is that people want to get care when it's, I wouldn't say too late, but when a situation is so far gone that it's an emergency. And
Right.
that's one thing that we're here today to talk about, is to avoid catastrophes, emergencies, and worse yet, if you're in an emergency situation, it's that much harder to get help. So
Right.
you want to be prepared.
And in fact,
So,
I always joke, in fact, that if someone calls me and says they want to buy long-term care insurance, it's usually too late.
right. Now, well, one thing you touched upon it a bit is, what do you look for in a long-term care policy? What are the features that you want to have? What's sort of the basic minimum that you would look for?
So the basic minimum, again, every policy is going to have the same definition,
Mhm.
two of six ADLs or severe cognitive impairment. But companies vary by some features within the policy, and then some features are standard to every policy. So my suggestion always is that certainly if you're under the age of 70, that you buy an inflation protection rider on the policy. And that's because if you don't need the care for 20 years and you don't have anything on the policy inflating your benefit
Okay.
amount,
Mhm.
you're going to be way underinsured at the time that you actually need
Mhm.
the care. So inflation riders are really important. You want a rider that if you're a husband and wife and one of you needs care, that the premiums for both of you stop,
Okay.
as opposed to just one half of the premium, because you're going to be spending money in other ways at that point. You want to have as little out-of-pocket expense going to the policy as possible.
So you pay for it jointly. In other words, the policy would be for one person or two people.
Correct.
Okay.
Well,
Mhm.
and sort of basically the answer is yes. Some companies do give you a joint policy, but they're technically separate policies, but
Got
it's
it.
still the same. It's the same
Okay.
sort of thing.
Okay. Mhm.
You can get riders that expedite the payment if you're receiving care at home, or calculate the care a little differently if you're at home. Those are all sorts of things to look at. There's different bells and whistles. The bells and whistles don't really mean very much. If you're planning, for example, on retiring overseas, and some people ask me about that. Well, I'm planning on spending my retirement years in Spain or Italy.
Mhm.
Will the policy cover me there? So that there's going to be a difference between companies on that. There are
Okay.
little things like what are called bed reservations. So if you have a room in a facility and they take you to the hospital for 4 days, you want to make sure that your room is still there when you get back. So different companies will have different amounts of time that they'll reserve your bed for. They'll continue to pay for your bed at the facility. To me, the most important part of long-term care insurance when you make that choice is not these little bells and whistles features, but it's the financial strength of the company you're dealing with, because we want to make sure the company is going to be around in 30 years.
So how do you select a company? What do you look for in the company itself when you're choosing that?
Yeah, I would look at a few things, the most important of which is financial strength, and then sort of with that, how long the company has been around, and a company that has a reputation for paying claims easily without putting consumers through a lot of hoops. When these policies were first brought to the market in the 80s, a lot of companies, in fact, almost all the companies that brought them out at that time, really underestimated what the costs were going to be and
Mhm.
how many claims they were going to have. And then today, when we have a low interest rate environment, that has an impact on how they can address, they can invest their money, their premium dollars. If you look at the year 2000, there were 125 insurance companies that were selling standalone long-term care policies. Today, there are fewer than 17.
Mm.
So it's because these companies weren't able to financially support these products anymore. Now, what happened to the other people who had policies with those other 108 companies? So it doesn't mean that those policies don't exist anymore. Those were contracts, and those insurance companies, for the most part, still do exist, or they were taken over by other insurance companies. But what it means is if you're an insurance company and you're not selling the product anymore, you probably aren't servicing it very much anymore either.
Right.
So when it comes claim time, or if you have a problem with your policy or a problem with a premium that you missed and like that, and you call the company, it's going to be really hard to find someone to provide you the level of service without waiting days or weeks to get an answer.
Now, are some of these companies were bought by the ones who are still providing and merged with them so that they were able to take that policy over so the client didn't lose it? The
Right.
other question I had for you is in that if you, if a company's closing or no longer carrying it or it gets carried over by someone, do you get anything back, any refund of any sort?
Typically not. So
Okay.
that, again, that's why you want to be careful. And insurance companies don't typically lose the policies when they go out of business or when they get taken over. Usually someone else picks up those policies because the insurance company doesn't think it looks very good for that to happen. You know, in the early 20th century, that happened, and there were legislation that was passed in the early 1900s as a result of that. But again, even if a company gets taken over, their policies get taken over by another company. So if I'm company A, you know, it's Robert's insurance company, and someone bought a policy for me, and Patricia's insurance company buys me, the policy still says Robert Insurance Company on it. So you might not really care if Robert's insurance company gets a bad name because you don't provide a lot of service to me. So even when they get taken over again, it still often has a negative impact on service. The last thing I would say is, if at all possible, you want to look for a mutual insurance company. And a mutual insurance company means that it's owned by its policy holders, and every decision that the company makes is based upon the best interests of the policy holders, as opposed to a stock company where every decision that's made is for the benefit of the stockholders. They're publicly traded, they have to meet quarterly numbers. A mutual company will look out much more frequently and in much greater depth for its policyholders, because that's who its owners are.
That is an interesting thing that I learned, a new thing I learned today. That's really, really excellent advice on that. And how do you qualify for long-term? Again, I guess it gets back to the criteria of your need is how you qualify for long-term. And what, go ahead, I'm sorry.
I was going to say, you know, you qualify for it with your health, basically.
Yeah.
Right. So it's like life insurance, disability insurance. You qualify it with your health. It's underwritten more like health insurance is. There's for the most part, no exams. Someone's not coming to your house. Though if you're over 65, they will often do some sort of cognitive test over the phone with you. What they're looking at is your medical history, primarily chronic conditions, primarily if you're on prescription medications, what those are. There could be things if you've had if you've had, disc issues in your back, or if there's been some fusion, on bones or things like that. Those are all sorts of things that are going to probably knock you out. If you have diabetes, if you have arthritis, if you have early symptoms of Alzheimer's. So you really are looking to buy this with your health, and which is why you want to buy it as young as you can and as early as you can. It's not just that the premiums are lower when you buy it younger, it's that your health is most likely better. If you look at the market of people buying long-term care insurance, the underwriting is pretty tough. Over 20% of people ages 50 to 59, which is not an age group that we normally associate with really bad health, over 20% of people in that age group are declined when they apply for long-term care insurance.
Right.
So the longer you wait, the worse it's going to get. Also, many companies now are no longer selling to people over age of 70. So that's also a reason not to wait until 70 to do this.
What is the sweet spot of an age? I know, full disclosure, I got long-term care insurance in my 40s. Truthfully, it was a cold call, and I ran it by my husband, and he was not in favor of it because he says, what do we need another thing to pay for? But I really felt strongly about it. So I was told under 50 is really the line of demarcation, and I had no ailments at that time to report that would be a high risk factor. So I can't say the premiums are cheap, but I'm sure they're a lot better than had I waited until I was in my.
Absolutely. I mean, I think that was a great decision.
Yeah.
I think that, and people buying long-term care insurance are getting younger and younger. Initially, the average age of people buying it was about 70. Now it's in the early 50s.
Oh, okay.
For exactly the same reason you say, under 40 is better. And again, there are other reasons to not wait. Part of it is that insurance companies close blocks of business and bring out new blocks of business as they understand experience in terms of how many claims they're going to have. Each new block of business is usually 20–30% more expensive than the old block. So when you wait, not only are you older, and not only might your health not be as good, but the block of business is going to be more expensive. It's some companies, for example, most companies today, for example, now charge women more than they charge men for long-term care insurance. So you want to get into those companies that are still remain before maybe something like that changes. And the other thing to remember is that premiums are not guaranteed on long-term care policies. They're projected to remain level for the life of the policy. They're not guaranteed. Pretty much every company has raised rates at least once on in-force policy holders. But again, if you buy it early, even with those increases, it's often less than it would be if you're buying a new policy today.
So let's say my policy is 6 years. This is what we were told. We'll do a case study, and that most women need 4 years and men need 2 years was the projection, which I'm sure that you've heard that. So let's say we both way outlive, or one of us out. So I have a combination of 6 years I can use any which way. So what happens when I outlive that? That's it? End of story?
End of story, yeah. So that's why I always tell people, especially if you're younger, 30 years from now, people are going to be living even longer. So maybe getting 12 years total, 6 years with each of you, might be a better choice going forward, just because people are going to live longer. We have these Alzheimer's statistics, which I mentioned before, which are sort of mind-blowing. I'd rather spend a little extra on some premiums that I don't need than have to pay out of pocket at a time when it's going to be really expensive because I didn't have enough insurance.
Right. And, it's a scary prospect. What other products are available to cover long-term healthcare costs?
So the insurance companies have developed other types of products that try to move most of the risk from them onto the policyholder. So you can get a permanent life insurance policy with some companies that have long-term care riders. Sometimes you can get annuities that have long-term care riders. Sometimes they're riders, sometimes they're what are called hybrid products. And it'd take too much time for us to go into them today, but they're out there. For some people, they are, I think, a great option. They require you to buy typically a large amount of life insurance. So some people may not want to do this. Premiums are usually a little bit more expensive. The one nice thing about these life insurance policies with riders is that most insurance companies are not selling long-term care to people under 40 any longer. But if you're a 30-year-old and you're concerned about long-term care, you can put one of these riders on your life insurance policy. So it's not quite as comprehensive. The inflation protection may not be quite as good, but it's still something. And so it may be a way of providing at least some care for yourself now, as opposed to later on when it may be extraordinarily expensive, or you might not even qualify for it.
And I always like to say this little bit of advice: no matter where you're at, it doesn't hurt to put a little money away. The old thing, $1 a day, is just put a little something. If you can't afford to put huge chunks of money away right now, maybe a little bit every day, a little bit every month. Those little things at the end of the year, if you put $1 away, you have $365 to do something with.
Exactly.
So, that little bit of us starting to pay attention, downsizing and consolidating is the big buzzwords now with age, and younger is better.
Right.
I really also would like to know, in terms of age limit, and it might sound crazy, but is it worth for grandparents now to buy these kinds of policies for small children, or is it even an option?
Again, if you probably can't do it with a standalone policy, but you could if you bought a grandchild a life insurance policy. A lot of people do these. I did it for my kids when they were little, not because, God forbid, you're expecting anything to happen, but because when they get older, now they have life insurance, they're paying from a very young rates, and they can add on the coverage. So to get a life insurance policy with a rider might not be a bad idea to do, and it's something they can utilize later on. But again, probably getting them a standalone policy, you're not going to be able to do that.
Right. So Robert, this has been so informative and absolutely, I learned so much today just in the short time that we've been talking. I know that you provide services nationwide. What would be the best way for our listeners to contact you?
They can call me. I can give you my number. It's 323-965-6327, or they can email me at rmsmith@financialguide.com. And to me, I think the lesson behind all of this is that there are really three reasons to buy long-term care insurance. You want to protect assets, peace of mind, especially to your family as well as to you, and you want to eliminate or at least reduce the financial burden on your family, which is sure to result given the statistics that we talked about earlier.
Right, and please don't be fearful. You know, this is something you need, and just at least start the investigation process. Give Robert a call or an email and just get the information. It doesn't hurt to just start investigating and looking into it and learning about it and see what needs can be met. Robert, thank you so much for joining us today. And I will put Robert's information on my website so you can contact us also at www.thefitnessgourmet.com. So thank you again, Robert. And you have a wonderful day, and hope to see you again soon.
Thanks so much.
Okay, take care. Bye-bye.